Alright guys, we're going to get started here in just a minute. Finally to the candy store. Oh yeah, good stuff. Alright, I think we got a quorum. Let's get started. Welcome to week 6 of the Rational Investor School for Trader Development. This is extensions and retracements, so Fibonacci's. This is the week where we start talking about how to identify location for our trades. So without further ado, what we're going to do is go through the two slide decks. There's one on retracements, one on extensions. Then we'll go through the quiz, the Q&A document, which so far is kind of short, but I'm sure you'll have more questions as we go through. And then I would really like to get into the trading log so we can look at some of the paper trades you guys have posted. All right. Tutorial 1, understanding and using fibs. This is part 1, retracements. All right. So what we're going to cover is the Fibonacci levels and non-Fibonacci level that we use in our retracement setup. We're going to talk about the 3 key components that are relevant to retracements, which is ranging markets. We're going to talk about first stop targets, reload zones and sweet spots, institutional fingerprints, and how we use fibs for range markets. This is CRI, that's from back before the class was in its current iteration, so I should say TRI uses fibs for range markets. All right. Actually, let me get my trading view going because we're going to need this as we go through here today. What is one Q4 layout? All right, and we'll dig in that in just a little bit here. But okay, so fibs stands for Fibonacci retracements. What we are looking for here is in a swing move in the market, so a bullish rally or well, frankly, a bearish rally, right? Either a strong move up or a strong move down. We want to know how much the market will take back from that move. Fibs are really interesting. All right, this is part of where when you talk to fundamental analysts or quants, this is where they often think that what we're doing is kind of voodoo, right? But it has stood the test of time, right? Fibonacci retracements has to do with Leonardo Fibonacci and his observation of a few mathematical constants that are present all over in the universe, right? Where that comes into intersection for us is these levels, these percentage movements, very often act as support and resistance levels. Now, whether that's because everybody expects them to, and so that's where they place their orders, and so it's kind of a self-fulfilling prophecy, or whether it's more of a matter of without direction, this is where the human brain places these stops or these orders. Doesn't really matter, to be honest. I mean, it's interesting, and it's something that I think most traders, at least technical analysts, like to conjecture about. But at the end of the day, the relevant point is not why it works, but that it works. Very consistently, we see movement demonstrate that key support and resistance levels appear at these Fibonacci retracement levels, right? In technical analysis, the retracement is created by taking 2 extreme points, as we said, usually major peak and trough on a chart, and dividing the vertical distance by the key Fibonacci ratios, right? The key Fibonacci ratios are 23.6, 38.2, 61.8, 78.6, and 88.6. Once these are identified, then horizontal lines are drawn and used to identify possible support and resistance. So, babe. Okay. All right. Sorry about that. So if we're looking at a fib, like we got here, we are looking at a swing move, such as, let me get up here to here. Let me put our study on here. Actually, let me apply the default drawing template first. So, and we'll go over this a little bit more here when we get into it, but the default drawing template has some combines extensions and retracements. It's important to note you really shouldn't. You should either do a retracement or an extension because these operate off two different scales, and I'll explain that in just a little bit. There's 80.6, I gotta add it. All right. Okay, so on this move down here, this is a big move down, right? We look at how much is it likely to take back, right? These are the key Fibonacci's, 23.6, 38.2. You'll see 50% is in here. We'll talk about that in a little bit. That's not a Fibonacci level. That is actually from W.D. Gann's studies. But it is something that we see quite a bit, so we keep it in our study. 61.8, 78.6, and 88.6, right? So we've moved down here. We want to see how much is the market going to be taking back, right? Or how much can we predict that they're going to take back? All right. There's a video link in here. It's pretty interesting. It talks about the Fibonacci spiral and its significance in our world, right? In technical analysis, we talk about how that works. Here we go. And so these ratios seem to play a very important part in the stock market and in asset pricing, right? And there's a whole segment of the community that just trades off of Fibonacci retracements. Now, as you know at TRI, we want you to have 3 reasons for any trade, right? But often when we look at harmonics, and we'll cover both location and price structure to get in, and there are ways that we can build a setup that has our 3 reasons around these harmonic levels, and we'll get into that. Really, honestly, that's more of a level 2, level 3 thing, but it is important to note that there is enough support for this that there are. You could even see there's a subclass of technical analysts that is just a harmonic trader, right? Steven, one of our site veterans, is a very good harmonic trader. I don't think that's exclusively what he does, but he does do quite a bit of harmonic trading. So we have an example here of some fibs drawn. This is done on the SPY back when Brian originally built the slide deck. So it's a little while ago. You can tell by the price range, right? The 4 key considerations when you're using retracements, okay? And it's important to distinguish retracements from extensions here. The 4 key things that we need to consider with retracements is retracements work best in ranging markets, right? Because what we're trying to predict is how much are we going to come back. Well, if we're still in our bull or bear trend, we're not ready to start coming back yet. Now, what we'll often do in a bull or bear market is we will keep extending our retracement tool as we go through, so that the ultimate move back to the first stop or 50% level adjusts with the market conditions, right? For instance, if we had been following this is the SPY, right? It's on a daily, but let me come down here. If we had been following this, with that study, right? We might have come up to here, and we see it rejects this 23.6 level, right? And then it keeps going up. So we just keep drawing this up each day, right? We keep adjusting. We keep our high. So as it goes down low, we leave this here. We want to see where it's going to go. When it makes new highs, we just pull this up with us, right? Until we get up to here. And you can see the higher we go, the more these expand because they're a percentage of that move, right? And that's really important. That helps us describe something that we often see in the market, which is the longer an uptrend occurs, the deeper it has to go for a correction, right? So you can imagine the full range of what we've been looking at on the S&P, right? Going back, to 2009, right? Is quite large, which means these distances are quite large, right? When we talk about a 38.2 retracement test, we're talking about a test way down here, right? And the market just freaked out because of this little move. So it's important to note when we see a correction from a very large move, there's often panic in the market around that correction, way before there needs to be talk about a reversal of trend, right? So we often talk about this 38.2 level. You'll notice in our studies in general, and we'll take a look at this in a little bit too, we typically do not use this 23.6 level. It's a valid Fibonacci retracement, but it doesn't seem to be as significant a resistance level as the 38.2 level is in most cases. So very often, like you'll see when I do a study, I don't show this 23.6 level at all. 38.2 is the first one I care about, and we refer to 38.2 as the first stop, right? This is the level that has to be resolved for us to know whether the market has determined that this is a reversal and we're going to go further, or if it's just a correction and the trend is going to continue. And then we have institutional fingerprints. All right, institutional fingerprints are pretty important. They're going to identify key support and resistance levels for us. And what we're looking for there is when we see a swing, the institutional fingerprint is the bar that made the lowest low or the highest high plus the preceding bar. Okay, those, and typically we're looking at a daily, but it doesn't. You also see institutional fingerprints on shorter time frames. You might see this on a 1 hour or a 30-minute, right? It's always the bar that made the low or high plus the preceding bar. That action of those two bars tells you a lot about what the institutions did here. Like this, we can see this came down further and then was rejected all the way up to this level, right? What do we see later on? We see that candle body level, we see great resistance right here, right? Came down, boom, no, we're going to move above that. So this is very common, and so institutional fingerprint is something we keep an eye on, right? And then we have this concept of a reload zone. When we're looking at the extensions, the area between the 61.8 level, which we call Mountain Man, based affectionately off of a person that Brian used to work with, I think at Top Step Traders, I'm not sure, and 78.6, right, what we call the line in the sand. This level in here, we refer to it as the reload zone. That is the area with the highest likelihood of us seeing a reversal once we've confirmed beyond the 38.2, right? So, and this zone here very often will conform with an ABCD pattern that we'll see develop on the reversal. JH, you ask on my trading view, why am I using line instead of candlestick? It's just because we've got a class on candlesticks coming up, and I don't want people to get too lost and dialed into candlesticks until we get there. I'm kind of trying to keep this chart in line with what you guys have learned so far. So Once we get to candlesticks, I'll be changing this from a line to candlestick charts, and then we'll be able to see some of that. And I should probably include that now, since we're starting to talk about institutional fingerprints, which is where we're looking at candlesticks. So let me go ahead and pop this over, and then we can see this a little better. All right. All right. So reload zone. Reload zone is very, very important. We use that quite a bit. All right. We get some short examples of fib extension, or sorry, fib retracements. So we see the institutional fingerprint here, highest high with the preceding bar, right? We see our reload zone still applies in a bearish move. So we did the retracement from this level to this level. And this is the 78.6, and this is the 61.8. And in between, we have the reload zone, right? Where we also see they put in a high right in the midst of that. This becomes the institutional fingerprint when we see that high is there. If we had made a higher high here, this would become the institutional fingerprint. You'll notice together they all seem to adhere on a candle body level to pretty close to the same level. In other words, we tested above it and then we'll reject it down. We often look at this sweet spot, 70.2, which I don't think is technically a Fibonacci retracement. What it is the middle of that sweet spot, right? One of the things I use in personally when I'm trading is when we get into a reload zone. So when I do a trade setup, my setups factor in my risk, which means if I have location, so this is the first thing I look for is location, and that's where we're talking about retracements. If we are looking for a trade, and let's say I was looking for, this is probably a bad chart to do it. If I'm looking for a trade, and let's assume a nasty thing, which is that we moved all the way down here. All right, let me just go sparse. All right, let's assume we moved all the way down to the reload zone, right? And we go here, we make a W, right? Let's pretend like that's what occurred. When that occurs, if we are, so let me put 707 on here. All right. So this whole thing here is the reload zone. Oh, I went too low. Sorry. This whole thing here is the reload zone, 61.8, 78.6. The middle of that is at 702, right? If the price action is, so let me take the main off. Okay, so if price action comes down here and then puts a W in, okay, if this W occurs like it did here, it goes below this 70.2, I will add a percentage to my risk. So what I do is I start my trade setup, as I'm looking for a setup, I start with 0%, so I'm not trading anything. If location is okay, if it's in the top half of this, I will move on to the next thing. I'll go from location to momentum, which we will learn about in future weeks. But I won't add a percentage yet, so it's still 0%. But if I get price movement down into the bottom half of the reload zone, or if it goes below the reload zone, then I will add a percentage into my risk that I'm going to take on that trade. All right. Okay. So that's where the sweet spot can factor in, for instance, on a setup. Now, that's my personal thing. It's not necessarily core TRI, factoring in risk, but I do like to do it. So, and then incorporating reload zones into your trading plan greatly improves your trade location. It really sets you up can you see how if you were trading at higher levels, right? If you're hunting up here, you don't really know if you're hunting like around the 38.2 whether we've resolved to continue to go down or whether we are rejecting. If we're down here and we put a W in, it's fairly reasonable to think that we had a down move and that we have exhausted that at this point. And it puts us in a good location for a return, right? And we'll talk about how we factor in returns in just a little bit today. So, because again, this would then represent another move, right? And then we're looking for the reloads on off of there as a idea of how far is the market going to take back, right? So that lets us do some targeting on price, and so that gives us a good risk to reward ratio. Yeah, generally speaking, Philippe, in a ranging market, what we typically look for is the reload zone being the location for a trade. And when I talk about the three things, when I talk about looking for a trade setup, I always look in the same order. I always look location, then momentum, and that's where we talk about like RSI and MACD, and we're going to talk about that in a little bit. Willie, we've got a few different pieces there. And then I look for price structure. Now, we have learned price structure. That's where we're looking at market reversal patterns. Right? That's where we're talking about triangles, head and shoulders, M's and W's. Okay. Here, let me bring this down. So we talk about price structure. We need to talk about momentum. That'll be future weeks, right? And what we're talking about right now is location. So we're talking about Fibonacci. Also, I'm horrible at spelling Fibonacci, so yeah, you might want to look that up if you want proper spelling. I don't know. All right, retracements. For retracements, when we're looking for ranging markets. Okay, so yeah, so this is the location criteria of the trade, I think is what you're asking. When you couple these with institutional fingerprints, which gives us an idea of resistance levels, right? Retail investors can trade like the institutions do. Once you add momentum and volume studies in, these really jump out to technicians, right? Pivot points become really strong at that point. And any of these opportunities wouldn't have revealed themselves with just price analysis, right? We really need the retracement study, and we really need to layer in the other reasons for a trade. Okay, so that's retracements, okay? So that's when we're looking for reversals in a market, and we want to predict how far is that reversal likely to go, and at what point can we confirm that it is a reversal. All right, so what you will see us do, and I would show you once my computer lets me move this. Here we go. So when setting up, so I have templates set up for my various things, and let me show you a little bit about how I did that. Okay, so when you come in here, you're going to see your defaults, apply defaults, okay, and by default, to your trading view does their study, and actually I'm gonna, yeah, no, this is fine. They do both the retracements and the extension levels. The problem is with what we're looking for, right? With a retracement, we are looking for how far is it going to come back. With an extension, we're looking for how far further is it going to go. So you can see that when you combine the two, your extensions are on the wrong side of the deal, right? We want to go from 1 to 0, 1 on the left, 0 on the right. When we're doing retracements, we go 0 to 1, 0 on the left, 1 to the right. I'm talking about this figure here, right? When we're doing an extension. So what we do is when you come in here, select your extension that you just drew. And if you come into the panel and you hit the gear icon and you go to style, then you can uncheck some of these levels. So I recommend you do that. Uncheck everything that's above 1, uncheck 0.236, and then anywhere in here, and I just use the 3 because we don't often, I mean, we sometimes do, we don't often use the 300%, 40% extensions, and I'm just going to override this. We're going to put 0.886, and then select that, and then I'm going to come into this one. I'm going to change this to 0.702. I'm going to select that. That gives me all the lines that I need on my chart. Now you'll notice in my default, I've got a bearish and a bullish one, and they're just colored differently is the only difference here. But so let's say we do bullish. You'll notice that mine are all gray except for my reload zone, right? And for some reason my 702 is not showing at the moment. That's weird. I think it's because I couldn't get the color to work right. So what I do is I have everything grayed out except the 786 level, and that leaves the level above it to the 786 as green. Okay. Conversely, if I were to apply my bearish one, it just colors it red. That's all. So that is retracement. So then once you've done that, actually, sorry, I didn't tell you. Once you've done that, you go into template, save as, and you can give it a name, right? Example name. And that way, when you select the study, you can come up here and you can go to example name. Okay. All right, let's move on to extensions. So, and obviously I'm doing the surface level so we can just go over it quickly, answer any big glaring questions. The videos Brian does are a lot more extensive than what I'm doing, okay? So be sure to review the class videos. All right. Extensions. So we're going to cover, there are extension levels. Are 3 components for the extensions. We typically use extensions in trending markets. We are not using extensions for location per se. We're looking for extensions to show us, instead of how much is the market taking back, we want to look at where are we likely to finish this move, right? Now, when we can see that extension match up with a reload zone from a previous move, that's very strong, right? So extensions, since we're looking for how much further are we going to go in this, are used in trending markets, not in ranging markets. Trending markets are described as higher highs and higher lows, or lower highs and lower lows. Okay, it's really important to remember when you're looking at a chart. Visually, we can see, okay, things are just going up. But what does that mean? That means that our highs are getting higher and our lows are also getting higher, right? That's a trending state, an upwards trending state, right? Conversely, we come over to here, we have lower lows. Lower highs, higher lows, not a trending state. Looking at a triangle, right? So if people say, oh, this is reversed and we're in a bearish state, we are not currently in a bearish state in the SPY. On a very short time frame, perhaps, right? We're just looking at this, which it's daily, it's 2 weeks. You might think that's a long time frame. And the overall nature of this move, though, can you see how that is not? And really, what we should be looking at this as a weekly, right? So on a weekly basis, we haven't really done enough to make this a bearish move. All right, so important to remember what a trending market is. And we're going to talk a little bit about the parking garage. The parking garage is kind of the closest thing to conceptually to a reload zone um, in what we're looking at. So if I were to go off of a shorter move here, so let's say we went up to here, and instead of looking for a retracement, we were looking for an extension of this move, right? Oh, that's the problem. I was like, I don't know why this isn't snapping to it. It's going to turn that off. Okay. So, when I go to my extension study, now I've saved this already, right? But we'll talk about what goes into the extension study here momentarily. When we are talking about the parking garage, we are talking about this zone here, right? The distance between the golden ratio, 1.618, and the 200% level, which technically is not a fib, but is a very common level, particularly in association with head and shoulders or an inverse head and shoulders. We often see a 200% extension of that head and shoulders formation. So that's a parking garage. Now, if we saw a parking garage, and we don't have any previous move because the SPY has been at all-time highs, but if we had a previous move in here that had a reload zone in this same area, that would be a very powerful indicator that that would be where we would top out at, right? So let's come back here. So let me close this so I can quit getting confused. So the levels we care about are the 113%, 127.2%, 144.5, 161.8, and 200%, right? And the 144.5 is just a halfway point between the 127.2 and the 161.8. And then when we talk about ABCD patterns, SPY is probably not the best thing to show you this in. Let me go to something else. Let's go to Bitcoin, for instance. I think we have a good example there. All right. So we're looking at it weekly on Bitcoin at the moment. Okay. We are looking at an ABCD. What we're looking for is if we take a move and we clone that move, and I've just gone Control C, Control V, or you can come in here and you can also, once you've drawn it, you can go, where's clone? Clone, we'll do the same thing. That preserves the angle and the distance on this, right? Then we look when it made its next peak, when the next reversal, we look at that to give us an idea of a likely extension level, right? This is the ABCD extension level. Now, Bitcoin folks probably won't like my little quick ad hoc here because it hates us going pretty low. But if you follow the daily breaks, you also know that I'm kind of looking for us to fill some other area down here around 5,000. So this isn't too far off for government work. But this is an ABCD pattern where no background. It's red. Towards A. Okay, so A here. B here. C here. Maybe. Sorry, they kind of like where I can't get it very easily. Let me grab it. Dang it. Hold on a second, guys. Sorry. So, A. B. C. D, or I'll put culmination down at the bottom. Okay, that's what we're talking about when we talk about an ABCD pattern. This is the most basic of harmonics. And we use ABCDs quite a bit. Share this out here. All right, so, and then we'll talk about how we use this. So, or extension levels. All right, extension levels best used in a trending market. Consists of all levels drawn beyond the 100% level and are used by many traders to determine where we will wish to take profits within a trending market. So oftentimes if I am looking, like there are some setups we have where we look to take profits at specific levels. On a 3-step setup, something that I will teach you guys, we look for a big move, we look for some structure. It's probably again a bad one. Let's look at gold. Okay, we look for a big move down. We draw a retracement off of it, and we will use targeting off of the retracements. That's the wrong one. Hold on. Sorry, I don't mean to confuse you with these non-fib levels. I have some other studies in here. We look for a 50% return very often as a target. But if we don't have something like that, like in this case, 50% looks like we have a gap here, but if we didn't have a good reason for that, we might instead look at an extension of this move. Say we got in here, we would look at extensions to put us somewhere 1.618 or possibly even 1.44 as our extension level, right? So extensions are most often used for targeting where you will exit the trade, targeting your profit-taking levels. And most often in TRI, I see them used as, how do I put it? So if you're not in a trade, you're seeing a trending move, you see a retracement level up above, like a reload zone up above, you might do an extension off your current move to see if that aligns with that retracement level, that RLZ. Because if those are in alignment, that gives you a good indication that is a good target for reversal. All right, so long example, ironically, with gold. So trending market state, right? We were coming up here, we're continuing moving up. The trending market state he's talking about is from this low to this high, right? He drew this from this low to this high, right? So this is the 0 to 1. Extension levels here, here, here. The 1.618 up here, that's the golden ratio, a really good profit-taking objective. The 200% extension, another excellent target, particularly if you have a head and shoulders that led you into it. And then what we're looking for is, can you find market structure or harmonic patterns? In this case, inverted head and shoulders, right? Can you see how this is a shoulder, head, shoulder? That's why we drew this particular distance. So that's the distance. This is the logical target off of an inverted head and shoulders, right? To validate your extension levels. We have a short example here, another gold ETF example. So we had this move down here that was our we originally drew off of. And then we have, you see how market structure in this example, let me see if I can blow this up a bit, really adhered to the resistance levels in play, right? 1.27 here, so we just bounced right off of that, then we came down, we hit and bounced on the 1.618, came up, came back down, Then we have the 2 level, and that's where we ultimately put in our bottom. Right? So, oh, we didn't put, actually we came down lower again. Yep. So, so this is how we use these extensions, right? We'll draw the move. We're looking for counter trends, resistance levels at these extensions. So, once a trading range has been established, extension targets give us logical stopping points to price them away from the range. Again, when we add volume and momentum studies, right, that's what we have an example of here, and this is what we're going to be learning in future weeks too, is to add these other studies as well. But once you have these extensions, then we can see, this is Willie, we're going to learn about that. This is MACD, we'll learn that. And this is LBV, we will also learn this. This is our volume study, and our 2 different momentum studies down below here, price momentum, volume momentum. And when you have these in conjunction, it gives us very powerful indicators of when we'll see a reversal. Okay. So that's fibs in a nutshell. You're going to be using these a lot, so don't expect that you're immediately completely comfortable with them. But as we go through, get used to these. Build your templates. Okay. So along the building the template side, let's do extensions and go into here, and I'll show you what I've put in here. So on my extensions, I've got the 0 line, none of the stuff in the middle, 1, 1.128, 1.272, 1.618, 1.44, and 2. That's it. Okay. You can add these other ones, but honestly, we most often see reversals by the parking garage here, by this 2 times level. Well, the top of the parking garage here. And the other important part is you need to have it set in reversed, because what reversed does is 0 becomes your leftmost line, 1 becomes your rightmost. If you are not reversed, like in a retracement, this is your 1, see how it's 1, and this is your 0 down here. Okay, that's going to tell you right away whether you've drawn your extensions correctly, because we often see people will draw them backwards. They'll put their 0 here and their 1 here for a retracement, or vice versa for their extensions. Okay. All right, let's go through the quiz really quick, and then we'll get into the Q&A. All right. The Fibonacci retracement tool is best used during what type of market states? We're talking about a retracement tool. So it's best used in a ranging market state. I want to see how much it's going to take back of the previous rally. The first stop target is in reference to which Fibonacci level? And Brian will, and all of us in daily briefs and so forth, we're going to refer to the first stop a lot. So become very familiar with this 38.2 level. And then, which the following is not a Fibonacci level? That's 50% level. We get the 50% level from a gentleman named W.D. Gann, and we do include it. It's a very common level that we watch for, but it is not a Fibonacci level per se. And then the reload zone is bounded by which 2 Fibonacci levels? We're looking for the mountain man to last stop, 61.8 to 78.6. And then the midpoint of that reload zone we refer to as the sweet spot. That's that 70.7%. All right. And then the line in the sand refers to which Fibonacci level? The line in the sand, or the lits, is what we refer to the 78.6 level. There is one further Fibonacci level, that's the 88.6. I don't know that we have a name for it at TRI, but we don't often see the 88.6 hit in the stock market. That will occasionally happen, but most often we'll see reversal in this reload zone that ends at the line in the sand. And then Mountain Man refers to which Fibonacci level? That's a 61.8%. Brian used to trade with this guy that he referred to as looking like a mountain man, which I think is a joke in the Q&A about my scruffy appearance. But he used to refer to this guy's Mountain Man. That was just his nickname in the community. You'll see a lot of traders like to give each other nicknames. It's a pretty common thing. All right. Extensions at this point should be primarily used as exit locations, right? So don't look at extensions as this is where we're going to try to get in on a trade. If it lines up with an RLZ, great, but it's the RLZ that's telling you that, excuse me, that's the RLZ that's telling you that you should be looking for an entry point. And then our best trade locations do occur when that happens, when we get an extension that projects prices into a reload zone. Okay. That's a very powerful signal. And then very often, this particular harmonic pattern lines up with extension levels. That's pretty easy because we've only taught you one harmonic extension pattern, right? That's the ABCD. And the ABCD, for instance, is what we use within the bot trading setup. All right. And which of the following is not an extension that TRI teaches? We teach 113, 127.2, 161.8. We do not teach 157. And why do we include the 144.5? That's because it's the midpoint. We could call it a sweet spot between 127.2 and 161.8. And which extension level does TRI not include? Or sorry, it does include, that is not a Fibonacci number. And that's the 200% level. 200% level is not a fib level, but it is a very common extension level that pertains to that ABCD pattern and is specifically something we look for with a head and shoulders or an inverted head and shoulders. And what market in transition pattern, so market in transition patterns are all these we have listed: double bottoms, double tops, triangles, head and shoulders, right? Which of these does the 200% extension level correspond to? And that is the head and shoulders. And what term does TRI use to describe the 161.8 to 200% extension level zone? And that is the parking garage. And then something Brian talks about in the video: in order to know that you can handle yourself and manage your actions in the marketplace, you really need to have a conversation with yourself, right? It's more important than talking to Brian or me or a wealth manager or investment manager. You really need to have a conversation with yourself about that is honest and clear about, can you manage yourself? Can you manage your emotions when it comes to trading? Very important. Trading is not necessarily for everybody. I think anybody can learn to do it. I don't necessarily think that everybody has the right temperament, right? If you can't control your emotions around trading, you're likely in the wrong field. and I'd say that a little tongue in cheek, in that I think people can learn pretty much anything they set their mind to, right? But I just mean you're going to have a lot more effort to do so, and it may be rewarding enough that it's fine, but you may have a lot of effort to do that if you have a hard time controlling your emotions around your trades. And then, based on the course material, select all the answers that represent TRI's valid reasons for a trade. What we're looking for, and I'm going to click these in the order that we look for them, okay, because the order matters. Location, first thing we look for. That's what we learned this week. Particularly with regards to retracements. When we talk about location, most of the time we're talking about retracement levels. Then we look for indicator confirmation, ideally with divergence, right? And then last but not least, we're going to look for market structure. Those are our three valid reasons for a trade. Now, trending market state is going to help us determine what kind of setups we're looking for, right? Ranging market state might tell us to look for other ones. Overbought conditions, we will get into a little later. Those are part of indicator confirmation, but the three things we look for is location, indicator confirmation, ideally with divergence. I refer to this as momentum, and then market structure. Then based on the lecture, what does TRI call people that make money from trading? Well, we call them institutions, we call them whales, we call them smart money. So I'd say all of the above. And then Fibonacci levels can be used to determine critical points in a chart that cause an asset's price to do what? And what we're looking for is often causes an asset's price to reverse. These are the resistance and support levels that we can predict based on those retracement levels. Well, retracement and extension levels, really. And then the Fibonacci retracement tool can be used to identify, so we're talking about the retracement level, identify possible areas of what? We're looking for support and resistance levels. And then when using the Fibonacci retracement tool and drawing from a swing high to a swing low, what is the study attempting to demonstrate? With all retracements, what we're trying to demonstrate is the amount of the rally, in this case, that the market will likely take back, right? We've made a move, we want to get an idea of how far back up are we looking, since prices very rarely just move in a straight line. They often do this zigzag thing, right? We want to know how far is the zag going to be to our first zig. And what is the definition of an institutional fingerprint? These are the signals that give us an indicator of what the institutions are doing. And that is the bar that made the high or the low plus the preceding bar. And then based on the class videos, if the market state is a bull, at what level will buyers step up and defend their positions? This is based on the class videos, so this is a specific situation. At what level will the buyers step up and defend their position? And in that video, what we're talking about there is a 78.6 level. We're talking about the line in the sand, right? If it's bull, right, you had buyers in here. When we come back down, let me do it this way. All right, so if we are in, let's go back a little ways and we can see this. Okay, if we are in a bull trend, right, and buyers bought their way up, they're going to step in and defend their position at this level, the line in the sand. Okay, that's what we're talking about. And then true or false, institutions do not buy up markets. That is true. They cannot. We'll talk, and there are a couple questions about why they cannot, and we'll talk about that here in a moment. And then complete the following sentence: buy when it what and sell when it what. And that's buy when it snows, sell when it goes. It's an often used aphorism in the stock buying community. Very often we see lows come in the winter, and we see highs come in the spring and early summer. Usually not into the summer, but in the very early summer. So the Fibonacci extension tool is best used during what type of market state? So when we're looking at extensions, we're looking at how far will this trend continue. It's a trending market state tool. And the Fibonacci extension level of 161.8 is known as what? And that is the golden ratio. You will also see it as my icon that I use very often. I'm really into fibs. I'm really into the golden ratio. Some pretty amazing correlation throughout the universe, throughout the world, right? I won't get off too much on a tangent, but this whole thing about E8 and the idea that we are perceiving 3D projections of higher multidimensional state, weirdly all comes back to that golden ratio. It's really weird. I'll share a video with you guys later. They can explain it far better than I can. Okay. You guys still hear me? You're quiet in chat. It's unusual. Are my talkers away today? Let's see, we had 16 people watching. Maybe you're waiting for the Q&A section. Okay. All right, cool. Thanks. Do you find that? I think you're saying, do I define the picture of Mountain Man? Perhaps. Maybe we need to rename that level Wookiee. But I don't trade like that guy did necessarily. The reason Brian refers to that as Mountain Man level is he used to trade with a guy who would look at. Thanks, Alex. He would see a trend happening, and he would put, and this is very, very stressful, right? But he would just put a bid in at the Mountain Man level, right? He'd put a buy in here, and he'd just wait, and it would come up, and it would come down. Oh God, it's gonna happen, and then it happens, and it goes lower. Oh God, I'm taking stress. A very stressful way to trade, but successful pretty often. You'll see Thomas often talks about Mountain Man always gets paid, right? Then when he does the buy here, he would do a sell. So, say we got the buy at this extension level, right? Which doesn't happen until like here. But let's hold on. I want to show you this is actually not the way that TRITs used to trade, but it's what this guy would do. So say he got filled here, right? Then he would put an order in to sell that at this Mountain Man level, right? Off of that move. Boom. So he'd fill here, he'd sell here, right? So that guy loved doing trades on Mountain Man. And he got paid a lot of the time, and I'm sure there were other rules around his trading, but because he operated off that 61.8 so often, Brian just calls that the Mountain Man level. Kind of funny little anecdote. All right. In the lecture, oh yeah, I thought I saw somebody post this on here. In the lecture, chart is written: institutions do not and cannot buy up markets. Why can they not? All right. So when you're an institutional trader, you're trading at a hedge fund or you're trading at a prop firm, right? You have rules that you have to follow. And more specifically, if you're at a hedge fund, say you run a hedge fund, in order to get people to invest with you, you're going to have certain rules in place, right? And one of the first rules that you will see in almost any prop firm, any hedge fund, is that don't buy up markets. They might phrase it a little differently, but what they're saying is don't buy up markets. The profit potential is very low, right? We're talking about you're in a trend, buying here is not going to happen, right? Because your risk to reward is going to be so low. If buying in here, you got to risk all the way down to new lows, right? They can't afford to take those kind of risks when they're trading with other people's money. Because bear in mind, when it's your own money and you take a risk and you fail, you have no one to blame but yourself, right? Okay, that sucked. It hurts. You lost your money. When you're trading somebody else's money, particularly large amounts of it, but when you're trading somebody else's money and you take an excessive risk, they might sue you. And they will. It'll happen. I guarantee when we have the big market correction that we expect to come before we get into another greed cycle, I guarantee there will be a ton of lawsuits against hedge funds that have lost people their money. So to protect themselves from lawsuits, these hedge funds have rules in there. And if you trade an up market, you're out the door. They're going to fire you straight up, right? They can't open themselves up to that liability. They can't open themselves up to that risk. So that's why. It's not that they technologically can't, but they have rules in place and they cannot trade an up market or they're risking their job. Okay. All right. Regarding fib extensions, 1.44 is the sweet spot between 1.6.8 and 1.272. What it does not clearly state is if this range is like an RLZ, zone overshoot, seller short. So it's not, bear in mind, when we're talking about extensions, we are not looking for, when we're talking about extensions, we are not talking about targets for retracement. We're talking about potential targets for taking profits, right? So we don't really want a zone in which we're going to take profits necessarily. You might set up, I mean, let me put it this way. That's not what we teach directly, but if somebody wanted to build a setup where what they look for is for an M or something to come in the middle of this zone, and that's where they're going to take profits, that'd be totally fine. That's acceptable. It's not in any of the setups that we have on the site and that we teach. I'd be interested to see if that vets well, and if you're able to get, you know, a decent win rate with that. I would imagine then you would need to do your risk to reward with the bottom end of that as your target, because that's going to give you your least risk to reward, which is what you want to base your setup on. So you need to at least have a 2-to-1 risk to reward to that lower end target, right? But you could do that, but we don't typically teach that necessarily as a zone per se. We just often see this as a resistance level. Like if you look here, and I just kind of winged this off of this range here. I was thinking back to, like, if you were looking at this, right, and we saw this action here, I might do an extension off that, right? First, I would see this in the retracement. I'd see we came down below 38.2, and then we're starting to reject off of it, right? And then I would probably look at this as an extension and say, okay, how much further do we think we're going to go? And that's where I go, oh, well, okay, you know, probably we're going to end up here. But you'll notice the action that we see at that level, we really see some support there, or really resistance to up there, right? So we came up, rejected down, came up again, rejected down, came up again, rejected down, came up again, rejected down, right? That really, these levels act as a really strong support and resistance level when we're looking at extensions. Yep. Brian points out here that later on in the education program, level 2 and really level 3 is where I think we get deep into it. We go into using extensions for trade location. That's harmonic trading. But right now, you're just using this for targeting your take profits. Yep. All right. But yeah, but I wouldn't necessarily call that a zone off the top of my head. But like I said, if you wanted to build a setup around making that a zone and taking profits, that'd be great. But you need to use the bottom of that zone when you're targeting your risk to reward ratio, so that you make sure you're not over putting yourself in too much risk. Okay. All right, and just to make sure I understand correctly, if I want to find a location for a buy using fib retracement, I'd have to look for a big drop continued with a rally over the first stop, 38.2 then. Not necessarily. You're going to look for a lot of pieces in conjunction, and we're going to teach you some of the other pieces as we get into it, right? For instance, if you were looking at this, let me change this over to okay. We don't necessarily need to see, to get into the trade, we don't necessarily need to see a confirmation above 38.2. But if we're talking about the market state, we need to see a resolution of this before we say that the market state has changed to bullish, right? But you might, for instance, if you had your 3 reasons, one of your reasons, might be that we have a previous RLZ guess that's the highest point, right? Okay, so let's look here. So if we're looking at an RLZ, we're looking at this level. So if price is within this level, right, that gives us good location. And in fact, we dipped below that halfway point. Let me re-add that in here. Might screw up my colors, but it's better that you see it than not see it. Oh, I did it. Excellent. Okay. So you guys see the reload zone here. We see that we're below this in the bottom half of that RLZ. In fact, we dipped just outside of the RLZ, right? In terms of location, this is a good location to get into a trade down here, right? But we need a couple other reasons. We're still going to need momentum, which we're going to learn in the next few weeks. And then we're going to need some kind of market structure, which we do have a W that printed in here, right? So yeah, go ahead and post that, Brian. That sounds great. Brian says he's got a cool piece on the stock market from the 17th century for anybody who liked the eating your vegetables part of this. So you don't necessarily need to see a confirmation beyond 38.2 in order to get into the trade. But when you're talking about market state, you need a resolution of that level. All right, and then if I want to find confluence between fib retracement and extension, I should look for this pattern in green in price, where the last price is where E is drawn. So I can buy the E position and sell the confluence between RLZ and 1.8. Well, that certainly wouldn't be bad. I mean, that's more or less what we look for when we look for an ABCD pattern, right? I mean, that's pretty strong. The bot, for instance, is built around this principle. If we're looking, so the ABCD pattern would be described in this as a BCDE pattern, right? So with a bot, when we look at the B to C, if the price moves down at least 33%, but not more than 66%, then we'll look for that D to E up here. Well, D to ultimate extension, right? The top of this right-hand red line. And we try to get in where we have like a 3-to-1 risk to reward, where we're risking to the bottom of this low here, and the reward is up in here. If that extension puts us into this RLZ, that is a very powerful and good sign. So I think you've got the right idea here. Is the short version. I think you've got the right idea based on what I'm looking at. But hopefully I was able to clarify that for anybody that was maybe a little confused. And hopefully didn't just confuse you further. We'll find out. In the course materials, we learned that when measuring fib extensions on a bull move, when price reaches the RLZ, we should sell. Vice versa, on a bear move, when price reaches RLZ, we should consider that a buy zone. Well, we're talking about fib retracements when we're talking about RLZs, not extensions. Is 6 a separate question? All right, I'm a little confused where these two things are related. So what we're talking about here is, when we're talking about RLZs, we're talking about these guys, okay? So, change my color here. We're talking about these, this red and this green. So, on this up move here, and then we came back down, this area represents a reload zone, an area where we're likely to see reversal. Conversely, when we move down here, when we come back up, if we come back up here, this area will be a good area for a downside reversal. So a good selling zone, buying zone. So I think that's what you're saying, but I'm not 100% sure. So hopefully that provided some clarification there. So to be abundantly clear. Let's do this in white. And I'm calling it shorting zone versus selling zone because when you buy down here, your target is often not necessarily Mountain Man. The most frequent target we use, just to give us some good realistic, good realistic levels, right, is we typically target either the 38.2, so we try to get in nice and low on here, right? So we'd want to get in lower than even that. We'd be looking for maybe a lower time. And this is a weekly, bear in mind. So if we were, let me get to it daily and see if we can still see all this stuff. One day. Okay. So if we were to get in here, we might have gotten in. Ooh, this is pretty sloppy. Let's say we could get a fill of this gap down here, right? If we could, we'd risk the new lows, and we'd look at taking profits maybe at the 38.2 level when we test against it, maybe the 50% level, right? 3 to 1. Sometimes things will look good enough. In this case, might be one of those. If you get in, you have a nice gap up here, you might look into taking profits in this shorting zone. But the main thing you're looking at this level for, this reload zone for, is, so say you got into a trade, you got out of it here, and price continues up. That's perfectly fine. This is where you'd be looking for an M to do a short on it, right? Yeah, that's right, Curtis, or Curdy. I don't know if your name's Curtis or not, but that's exactly what I'm describing. Is this is more of a shorting zone than it is a culmination for this. Now, if we were in a setup, and we were to, like, one of the setups might be this ABCD off of the low here, and so you might have just gotten in down here on a lower time frame and taken profits here, right? Something like that would have been your buying setup. Your shorting setup would be up in here, and you might have like you might end up with an ABCD pattern that takes you down to that level, right? All right, Kurt, thank you. One of my very good friends is named Kurt, in fact. All right, so that's what we're talking about. These are not necessarily, this is not necessarily one trade. Sometimes we'll see a trade where, Mountain Man would have put his sell order up here, but very rarely are we going to see a sell order all the way up in the other reload zone. We'll usually sell somewhere in here from our position that we bought here, and then we'll look to buy a short position up in here, or we'll just look, maybe we can't buy short positions, maybe we're not on a margin account, and so we just look for a reversal in here, and that's going to let us start watching for another buy area. Okay. All right. Let me look at this chart now and see what do we got here. Lower highs, higher lows. This is, you say, is this a valid range? It is ranging. It is tightening. So this, what we're looking at here is a triangle, right? Coming down here and up here. And then that, true to form, broke about 2/3 of the way through, and it broke on the downside, and then it moved on down. So you can trade a triangle, right? Or you can also trade a descending or ascending wedge. You just have to be aware of where your resistance levels are, and you need to find trades that still give you at least a 2-to-1 risk to reward within that. So in answer to that, no, you don't necessarily need horizontal levels to give you that range. A range trader really prefers a proper horizontal line range so that they're not having to fight with either a widening or narrowing range. but realistically that doesn't happen very often. Very often what we see is either a declining range, which generally I think we prefer to trade certainly over the opposite, which is an expanding range. We often refer to those as megaphones. Expanding ranges are extremely dangerous because it's hard to predict when they're going to break, right? And your swing keeps getting larger and larger. And megaphones we generally try to stay away from. All right, what else we got in this chart? I find it very hard to find a position that has a ratio of 2, taking profit in RLZ, entry after. Okay, so yeah, I think the problem here is you got a mixed message about the 38.2. We don't necessarily need to resolve the 38.2 before you get into the trade. In fact, very often we're taking the trade well below that when we have structure and divergence and location all down very low. We'll take trades down in this area very often. So we've come nowhere near the 38.2. In fact, oftentimes I will get into a trade, particularly a type of trade called a 3-step setup, or an L-tanginator. I will get into a trade down here, and my target will very often be the 38.2 because I know we're going to need to retest it, right? So I think that's where it's becoming difficult for you is you're looking for confirmation above the 38.2 and then taking that. You don't need to do that. The 38.2, the first stop, primarily what we're concerned about is when you're describing the market state, okay? We were in a bearish market state here. I don't think we can say the bearish market state has stopped and that we've entered a bullish market state until this 38.2 is resolved. But we don't need to be in the other state to take our trades, our reversal trades. We actually want to predict those changes in state. Material on fibs is very clear, but what I found was that in practice it becomes confusing due to finding the range trend when zooming in and out. Sure. Can I use 5 or 10 minutes today's session to show us exactly what process I look for in location? And what kind of price pattern do you look for in order to find location for short long? Okay, so when I'm looking at market state, okay, what I am looking for is hard to describe in like mathematical terms. In fact, very often, and it is possible, but very often people come to me when I'm teaching or when we're talking on the daily brief or when I'm just chatting with folks. They will come to me and say, okay, I want to build some automation around this. And I totally get that. I totally am 100% behind building automation, using our knowledge to create our rules, and then having our rules implemented by a machine sounds fantastic. The problem always comes in determining where you're going to draw your fibs. That's the hardest thing to algorithmically decide. It is somewhat subjective. Now, let me do this as a line. It's going to be easier to see on the screen here, and it doesn't really matter for what we're doing. Okay, so when we're looking at the market, right, it is easy for me to look and tell that this is a trend. This is an upwards trend, right? And look and see, and then we had this downwards trend. And then we had another upwards trend, right? That's easy for me to see visually. It is hard for me to describe, here's the point at which you put your fib. But what I do is I'm looking at this, I would put my fib at the bottom of that trend up to the top of that trend, right? That's what I'm doing when I'm looking for location. Is okay, so we had this trend here that looks like it's played itself out, and really I kind of work my way backwards, to be honest. So I'm going to come to price. Current price is over here. Right? Go this way. Go this way. Okay, I'm going to look at price. Let's say, okay, what was the last move? Okay, well that was from up here down to here. right? That was bearish. What was the move before that? Now the market, I know, and you will become comfortable with the idea that the market, any market given a sufficient amount of time, is ranging. Any market on a short enough scale is trending, right? What that means is what goes up must come down. So we came down here. Did we have previous action in the market? Okay, well then where did we come up from before? Using those, I can see where my reload zones are, right? Most importantly, I can see where my reload zone was on the last move, and I can see that I am in it, right? Right here, color this the right color. I can see we had a reload zone here, and that's where we're at. Then I can see, okay, well, where am I likely to take profits? Well, 38.2, 50%, 61.8, right? Probably most of the time I look to take profits around here. So then I look and see, do we have a 2-to-1 risk to reward? No way. All right, so I look at that and I go, right now I can't get in here. This is too high. It's gone too far, right? Because I have to risk to new lows, right? Then I might look and see, do I have some kind of ABCD extension that I can take advantage of to get me into this longer term trade with an acceptable level of risk. Now I don't in this case. The gold spider is just a little too choppy, right? But that's basically what I do. All right, I go to where we're at in price. Maybe we're up high. Okay, well, where did we come from? All right, what was the move before that? That's what I'm doing when it comes to, and you can see when we came to candles, we had some wicks up here that I didn't have covered. Sorry, a little OCD. But that's what I do. I work my way backwards. Where did we come from? Where did that come from? Right? And you can keep doing this back further and further, and it's not necessarily a bad idea. Though once I draw those first two, what I'll do is I will drop out to a higher time frame. And it's worth noting that when we talk about Fibonacci's, those stay the same regardless of the time frame, right? The only thing that might change is you might have drawn it to say here, and then you go out to a weekly and you see, oh, that was actually part of this larger move, right? And that move came from here, right? You see how what we see in the market is patterns. Now, can you see how this is kind of ranging, right? This thing here, not this one, but the one before it, change it, is a very strong thing that we call a reload zone within a reload zone. Okay, we had a reload zone, then price moved in such a way that our next reload zone was the same thing. That's a very powerful wall of resistance to price moving up beyond that point. Okay. Yeah, I mean, it does have to do with what kind of trader you are. So Dreamfool says, I guess it has to do with what kind of trader you are. A day trader versus swing trader will interested in different time frames. Yeah, absolutely. So if we are day trading, we're looking on a 30-minute scale. Right? It's still kind of the same process, but as we come out in time frame, we're going to see that those moves are encapsulated, right? So, so on a daily, I might look and say, okay, where are we at now? Okay, here's where we're at now. And bearish, right? And where did we come from? So that's where I come down here and I go, okay, well, we came from this move. And really, I think we kind of need to go to this guy here, right? And then we need to go to this guy here. This guy here. And I think that's probably good for at the moment to give us a picture of our respective movements, right? So right now we can see we have this reload zone here. We are right in the middle of this reload zone on a 30-minute chart, right? So this is like a day trader's chart. But our target, where's our target, right? Now we do have, it's interesting to note here, if we expand this up, on a 30-minute chart. Now this is the Spider ETF, so obviously we're on the weekend. This isn't currently in action. But if this were the middle of the morning, and this is what we're looking at, right? You actually have what looks to be not too bad of a risk to reward setup if you get everything you need to get in here, right? Which we don't really have yet, and we'll talk about why later. But you can see we don't have market structure for sure, right? We would need to get a confirmed bar above here, and then say we put a bid in at the opening of that bar, and we got in here. We got a 2-to-1 up to the 38.2. That's great, right? You can even go to 50%. We'll have a 3-to-1. That's fine, right? But you can see how we have it set up on this one because we're low enough down that we can get that good risk to reward. So that's the difference on a daytime, right? Yep. 30-minute is probably the most common that I see for day traders. 15-minute and even really short 1 minute, 5 minutes I've seen too. But most often what I see is like a 30-minute. 1 hour is kind of too long. If you put a 1 hour on, unless you're trading strictly at the very opening of a session, 1 hour, you're just not going to get enough candles to complete your order and get out of there the same day. But the process is the same. This is the thing I talk about often. The process is time frame agnostic, right? Drawing fibs is time frame agnostic. It's also asset agnostic. It doesn't care what asset you're in. It doesn't care what time frame you're in. The fibs work either way. But this is the process I go through. Where are we currently at? How did we get there? How did we get up to that part or down to that part? How did we get the one before it? And that gives us a picture of the movement of our reload zones. Like you can see, we even on the short time frame, we have a overlapping reload zone inside a reload zone up in here. So that's going to be a really strong area of resistance, right? Okay. Hopefully that helped. With crypto, does IFP involvement still apply? Yes, absolutely. We absolutely are seeing institutional action within crypto markets, which is I think what that question ultimately is asking is, do we have institutional investors actually involved in these markets? Yeah, absolutely they are. Now, are these prop firms? I think for the most part, our big institutional players in here are probably more like hedge funds, right? Because they have a lot more discretion on what they can invest in, and they don't necessarily have to report it depending how the hedge fund's organized. They don't have to do the detailed reporting to the SEC. So I think our institutional players, but for the most part, in the crypto space, are more hedge funds than like Goldman Sachs desks and stuff like that. Though I do think when it comes to Bitcoin, when it comes to like kind of the top five, like we're talking Bitcoin, Ethereum, Litecoin, unfortunately Ripple, I think we are talking about some major institutional desks. All right, back to M's and W's. Is the effect lost if you aren't seeing the M or W finish at the present price? All right, here's the example. So what I'm seeing here is we had this big W that's drawn on the chart. That confirmed at when price closed above this level. Oh, so if you, Pete says, so if you find a W, you don't necessarily need to enter on confirmation. You can wait for it to retrace. Absolutely. That's what I do most of the time. So if I am trading, all right, let me give you this example. Here's an example where I would not have gotten filled, but I'll show you an example where I would have gotten filled in a minute. So see this W here, right? If I had my other reasons for my trade, and I guess no, I probably wouldn't have gotten filled. I would definitely wouldn't. When this confirmed on this candle, you see this? This is a 30-minute chart. This confirmed on this candle. What I will often do now, actually, let me show you apples to apples. So I'm typically trading on a 4-hour chart. It's 240 minutes. Let me do this on a 4-hour chart just so you see what I look for. Okay. Not a confirmed W, not a confirmed W. Let me find you. It was a bad chart. So give me a Here we go. Okay. So you have this W here. Down, up, down, up. This W confirms on this candle. Okay. What I will often do is set my order once that confirms. So after the candle closes, okay, I will then place my order at the level here, which is the candle body opening. So I'll set my buy here, because very often we will explore the bottom of this candle before we move fully upward. Right? Now I still have to have location. I still have to have momentum. I'm just talking about how I deal with entry when I get a W. That is very common. If I have a candle that confirms my W that's just a solid bar, right? Instead of entering at the bottom of that bar, what I'll do is I'll do a fib range on it, and I'll enter at the 78.6 of that bar. Right? That's really common. Now, does that mean sometimes it'll just walk away from me and won't get filled? Yeah, but I want the best risk to reward ratio I can get, and there's always another spot for a trade later on or on another asset. So if it reaches more than that bar, if I did that order, I'll take the order where it takes it. I'm going to risk down to new lows, right? So I'm going to risk down to here. And so if it fills at this level, and then I take a bunch of heat on it, as long as it doesn't go below this level, I'm still in it, right? And it'll keep, and hopefully it'll go up. If it comes and stops me out here, it stops me out. If you're actively watching, what you can do as well, so this is a 4-hour, what I could do is, say it's 4-hour, but I'm day trading. So I see the structure on the 4-hour, but I'm looking to enter on a 30-minute. What I might do is watch this for a W at or below this, right? So I know I've gotten, this is my order level, and so what I'm looking to do is enter somewhere down here. So I'll look for another W. But typically I don't do that. What I do is I'll place my order here with my stop here and my take profit wherever it's going to be, 38.2 level, 50% level. Why am I risking? Well, you have to risk to new lows. So what you're getting with a W, okay, is you are getting levels of resistance to support your trade. So, so here's a level of resistance, right? And here's a level of resistance. Your risk when you're looking at a W, when you're looking at any kind of structure, is a break of that structure. Well, the structure breaks here. So you have to expect price is going to move around in here, and you're going to need to set your risk there. If you set your risk above that point, you'll probably get stopped out because price is going to move around in here, right? If you and if you set your level below that level, I mean, as long as you have a 2-to-1, that's fine, right? In actuality, I don't risk just to this level. I usually go a couple ticks below it, right? But yeah, I mean, can you understand how if we had price action move in here, if we're basing our decision off of the structure, that we need to risk to the low of that structure. I mean, at a minimum, you may set your risk down here. Like in this case, right, we have this tail that comes all the way down here. If for some reason you have a reason for it in your setup for a target way up here and you can get a 2-to-1 and risk all the way down to here, by all means. But that basically means you're working off of this W, right? Well, it's not really W yet. It'd have to break this level. But let's see. What if price gets here and you haven't entered yet? So, so Pete, when I think what you're describing here, let me use my example some more. Okay. So we were talking about if we made the W here and we put our order here. Okay. So you're saying, what if price comes down to, where's my drawing tool? It's down here. You're saying, what if price comes down to here or lower, right? Well, if I put my order in here, as soon as price hits here, it's going to fill. And when I do that, I got a risk down to my break of the W, the low of that W. Right, so this is my risk point. Let's color this different. Right, so when I enter this, as soon as it enters, I'm going to put a stop in here. That stop's going to be there. And then it does whatever it's going to do. Right, and then hopefully I'm also able to put my take profit up wherever I take my profit at. Right? In this scenario, that might be just to eyeball something, right? Right. That might be something like this. Maybe I'm risking to a 50% level, so I get 2.6. You know, I'm gonna risk to that when I get into it going lower. Now, when I do a blind order like this, okay, as opposed to, how do I put it? So when I have, like I described earlier, this W gives us multiple resistance levels, right? We actually have more than two in this particular case. Right? We got one here, came up, one here. Technically, we have a W right here, right? See that? Then we have another W up here that gives us another resistance level, right? If you're going to risk to this low, you've got 1, 2, 3 points of resistance. If I have 3 or more points of resistance, I will add a percentage for my trade. But if I just have a W, then I'll usually just enter 0% for the structure part of the trade. Yeah, I think that answers your question there, Pete. Let me know if it's still unclear. If I place this order here, I'm placing the order. If it'll fill whenever price hits there. If it goes lower, it just stays on as long as I haven't hit the, as long as I haven't hit my stop. Okay. You give us a really good explanation of M's and W's that, for me, at least clarified that the highs and lows don't need to be, and actually aren't supposed to be the same horizontal from each other. Yep. Can you give any similar clarification for head and shoulders patterns? Do the head and shoulders need to be level with each other, or can they be higher or lower? Generally speaking, with the head and shoulders, I prefer that the shoulders are describing a single support level. If it's inverted, a single support level. If it's a normal head shoulders, a single resistance level, right? So in this case, right, can you see how we have a shoulder, right, head, and kind of a shoulder here, but we've got a problem from my vantage in that this describes a low here, or sorry, this describes a high here. I'm thinking of it upside down. This describes a high here, and so I really want to see this again. So when we get to here is when I might consider that inverted head and shoulders completed, right? Because I like to see a good horizontal level there. Because what you're describing, well, the head and shoulders, let me move this over. What you're describing with the head and shoulders is comes down to here, comes up to here, down to here, right? What we're describing is a break of this level. And so this is a resistance level that it's fighting against, right? This is so we had an upwards trend, higher highs, higher lows, right? And then we reversed, and now we're making lower highs and lower lows, but we've tested against this level, and we need to see a break out of this level. And for a head and shoulders, I really want to see those be the same approximate level, right? Now it's not going to be probably to the T the same exact level. But if you look at the overall movement, if this is a small amount, and it's not like an algorithmic thing, I'm just thinking a small movement, right? There's difference between if it's like angled like that or if it's angled like that, right? But the difference is basically what you're describing, right? What we're ultimately describing with the right side of a head and shoulders is a descending triangle, right? Testing against the same level and breaking out. That's ultimately what we want to see. So that matters to me. I would like to see that. Move this down here so I can see. I'd like to see that be about the same level, because if it's not, instead of, I'm bad at drawing. Let me get back here. So if it's not, instead of that, what we're going to see is, so we want to see something like this, and then price moving down, right? So we have a descending triangle. If that is different, what we're actually seeing is, like, say it's angled down, then what we're seeing is a wedge, right? A descending wedge, right? If it's angled up, what we're seeing is more of a regular triangle. Those aren't bad formations on the right-hand side of the head and shoulders, but the best one, I would think, would be a descending triangle, where we have a relatively flat bottom, and then we're coming down to it, and then ultimately breaking out of it. Yeah. You basically, a head and shoulders is that. It's what we're describing, right, is a move from what was kind of a megaphone, right? Really, it's an expanding wedge, into a descending triangle. You've got it. Okay. And why is it institutionally kept by? I think we answered this one earlier. They're not allowed to. They're going to have rules within their hedge funds and within their prop firms that don't allow them to buy up markets. I mean, I suppose they can. They're just going to get fired, so it's not going to happen. Awesome, Kurt. Glad to hear it. So I think that's all of the questions in there. Anybody else have anything on chat before I move on to looking at a few of these paper trades? If you do, let me know. All right, so, oh, you guys are great. I love seeing all these paper trades in here. This is fantastic. Okay, so I'm going to start at this end and work my way back. Just because I meant to get to it last week, and I'm sorry we ran out of time. All right, looking at a W here. I like that W. You can see where it broke here when we had this confirmation above. This is a weekly W too. I like that. Doing 2-to-1 risk reward. Now that you have the tools. Oh, I'm sorry. I didn't see that random. Hold on a second. Let me scroll up. All right, so Random posted this earlier, and he wanted to know if this looks like an RLZ inside an RLZ. It's a little hard for me to see here. Let me. So we got the reload zone here, and then the okay, I see, and the overall, yeah, absolutely, yeah. So what we're talking about here, what is this? Is it XPT? Daily. Okay. What he's noticing here is, I'm not sure where you drew your line from in here, but let's take a look at this level. All right. You can even go all the way down. Looks like you maybe came from lower. So let's go all the way down here. Pretty close to a base there, right? If we look at that, what we can see is that our reload zone here, that we are in the midst of this reload zone, right? It's pretty powerful. Now, if we also look, we can draw some reload zones off of other ranges we've had, right? We can see that's a reload zone inside a reload zone, right? Here, that's a reload zone inside a reload zone inside a reload zone, right? This is, we refer to this as tightening of the coil as well. All right, as range decreases, as we tighten, right, we're gonna see reload zones get printed that are within each other, pretty more on a more and more basis until we finally break out, right? Now, important to note that we also need to draw the inverse to get an idea of how far up are we looking, right? So where's our lowest low? Here we go. All right. So up in here, we can draw this again. This is just off of Bitcoin. Bearish, right? So we're looking at like a 38.2 is way up here at like 11 grand off of this overall move, right? And as we move down, we'll continue, but you'll see we're also starting to make higher lows. So, yep, there's a not entirely, it is not without a compelling story for a long here for Bitcoin overall, but keep in mind these days are made up of hours, and we have to resolve all the rest of this. And you'll see there's more to the study than just fibs, right? Look, but location is getting it. We are pretty ripe for a retracement. Let me put it that way, for a reversal, I should say. So, okay. Now, back to our previously scheduled. Okay, so this W looks great. I like this W. Now you have tools where you can draw retracement, right, from here down to here, and figure out where like the 38.2 level is, which is probably up here even just a little bit more, which will be even better than a 2-to-1 risk to reward. But I absolutely like this weekly W. Good job. What else we got? Did I just break it? I did. Okay. All right. Bank of America. problem with this particular one is we really need to risk to the top of that M, right? And the other thing too is when you're talking about this structure, I think you're going to find, like, if you do a fib retracement, now that you have the tool, do a fib retracement from here, and you're going to find we're pretty deep in. I don't mind that you did the 2-to-1. I like the M here. I would have rather have seen the 2-to-1 come off of a break of that M up here, right? The confirmation here. Rather than starting it down here. I think you're just overextended here. While you did draw a 2-to-1, the likelihood is, I mean, do you think we're going to get down to here before we retest here? Maybe, but I wouldn't call it necessarily likely. So one of the things you need to look at here, let's go out there on my chart and I'll show you what I'm talking about. So we're looking at a 1 week. And this would be BAC. All right. Now, if we're looking at a weekly, not necessarily a foregone bad thing, right? Come up to here. What do we got as far as a retracement? I put this down here and I forgot that I put it there. Okay. So, I think realistically on a weekly, looking for a 38.2 isn't necessarily a bad idea. But this, we really need, the problem is we need some more structure. And once we get there, I think we're going to be beyond a 2-to-1. Right? If we got in a confirmation of this, and let's say we're able to get back up here to get our order entry. Even with that, we really need to risk at least to new highs here, and that's not going to be a 2-to-1. You're talking about a target down here, right? 2-to-1. Do I think that's unrealistic? Yeah, I think you're gonna be hard pressed to get this filled. Now you might. There is a nice, sweet little gap there, but I think we need to see for what you know right now. This isn't bad, right? Though I would prefer to see it up here, right? That's where the M really. We had an M break here. We had a second M confirm here. That's where I'd like to see us get in with a risk up to here and profits down. That's what I'd like to see. I think you're getting in a little low here. All right. Kind of similar, actually. Much wider M on this, right? So break here. I think the earliest you could have gotten in was kind of here. That's, I mean, maybe. Now that you have the tool, I'd like to see you maybe do up a retracement study. That's a big, long weekly, right? I mean, that's the market. Break down to there would be an awfully big move, but not beyond the realms of possibility. We'll learn some more about internals that might support or block against that, but overall, that is a good M. I mean, in terms of the M study, that's good. I like that. All right, what else we got? So Kurt, I think you got a good handle on this in general. W, I like. I think we clarified some of the other things. I think you'll see, you'll make some adjustments to trades moving forward, but these are all really good, man. Good W. I like the W's I'm seeing. The W's and the M's are spot on. Yep. Higher lows like that. Yeah, it looks great. Alright, Adam, let's see what you got here. Yeah, that's definitely that's definitely a W. You can see it had to come up to here and close to confirm. Look at the line. This is probably a line of closes, so that's fine. So that's not too bad. I don't know that you needed to risk all the way down to here. I'm not sad that you were able to do that, but I think you could even put your risk down to the beginning of that W, and then you require much less of an extreme move in order to get your 2 to 1. All right. Similar, yep. Definitely have a W there. I think you can afford to risk to that W, and then you, again, less of a required move there. I don't mind this larger one, but can you see how this larger piece hasn't confirmed a W yet? But if we come up to here, then you've got a nice big fat W you can risk down to here, and that would make sense for this larger move. Okay, what else we got? Similar, yep. Yeah, I like that. Got a nice W. I like how bowl shaped that W is. I'm gonna say bowl shaped because I'll get in trouble with the ladies if I say the other thing I'm thinking about. But that's nice. I like that. All right, Tammy, what you got? All right. So here on this one, can you see how this right hand shoulder is higher than this one? So this isn't really our M, but we do have an M in play here. If you look at this, we came down, then we come up here and come down. We confirm this overall M, but it's going to require that you risk up to the top of this. And I know you're out of town right now, Tammy. So you'll see this when you get it, but let me know when you do review this video if that makes sense. That this overall M is what you're looking for, and then you got to risk up to the top of that M. So your requisite target has to be a little lower, right? Actually, quite a bit lower. So, but not bad, not bad. But you need to keep in mind that what we're describing are we need to see lower highs on an M. Right. All right, what we got here? Repeat. Here's my only problem with this. When I look for a W, I want to see the candle close above that middle level. Right. As long as you're consistent with it, you can use your wicks to confirm the W's, but I think you'll find that your win rate is a lot lower than what you need it to be. I really look for the candle body to close above this middle, right? And you haven't seen that yet. That being said, I think you get the general idea, right? You have higher lows here. I like that. You are looking for the neckline, but the key differentiator is I will use wicks as my middle point, like this is the highest point here, but I want to see a candle body close above that level for me to consider that confirmed. All right, got time for a few more. We're already over a little bit, and I do need to see if we have any more questions before I go, but let me look at a few of these. I'm not really seeing I'm not really seeing an M or a W here, so I'm not sure what you're looking for in this particular setup. I think you need to describe it a little more. This might have been early enough. I don't know when this went in, but right now this doesn't have any kind of structure to it, right? We came up, and then we just went down. We don't really have a W here at all, right? For it to be a W, we would need to see like a bullish bar that closes us above this middle line here. Hopefully that makes sense. Ah, okay, so you said W turning into an M. Maybe. I mean, before they're printed, M's and W's both look like each other. So I think what you really want is to wait for that confirmation. Okay. Yeah, kind of the same thing here. Um, it's not as helpful when you're trying to draw charts when you haven't got the M or W printed. Let's see here. What do we got on this one? This is definitely an M, right? So we came up here. We put our low in here. Then we came up and then we printed below that level. This is definitely an M, but the M occurs here. M, so we're headed down. And right now you have this is a long risk reward tool. So you're expecting this to go up when you look at this. So you need to use the short tool. Short tool, and you would enter down here, okay? Maybe at the top of this, but you want to go down, right? So if you entered here, you would risk to new highs. You'd risk up to here, and then you need to take profits at least 2 to 1. So you're going to be down here somewhere, okay? All right, we got a W here. Oh, that's pretty sloppy. You probably want to come out on ones like this where we see these bars, right? That aren't really bars. You probably want to come out to a weekly on this. I wouldn't count this as a W. Technically, all the points align, and if you looked at this on a line chart, it would look like a W, but there's just not enough volume here to give you a good feeling for, is this actually price movement, or is this just there was an order up here, there was an order down here, right? Hopefully that makes sense. You probably want to look at that as on a weekly. All right. W. Yeah, I like that. The confirmation of the W was down here. If you could place an order down here and get filled, that would be a better risk to reward ratio, right? Because you have your risk right. That's perfect. I just think getting in here, this is a bit of a stretch target, right? If you did a retracement here, now that you have the tool, right? Do a retracement here, and let's see what those numbers look like, right? Go back a ways and see if you can find an upwards movement that you can look for a reload zone. See if we're around that reload zone or if we're above it. But it's a good start. And you definitely get the right idea. This is higher lows. We got a confirmed neckline break here. So that looks good. I just think our entry is a little high on that. All right. Okay, let me go back and see if there's any questions that came up while I was doing that. Okay, good. I'm glad I was able to give you some clarification, Philippe. Bearing in mind, I understand that a lot of this stuff was entered a while ago. We didn't get a chance to look at it last week, so I mean, I may be critiquing something you already have figured out, and that's no bad reflection on any of you guys. I just want to give you some feedback. So, okay, let's see if any other questions have come up in here. No, and I don't see anything on chat. I think I'd better wrap it up, guys, before my wife, tears me a new one. Though she's a very nice lady. She is Canadian after all. But I better wrap it up. If you have any other questions, please feel free to PM me, to put it in the chat, and to put it on the document, okay? Next week, we're going to talk about candle patterns. That's going to be awesome. So, lots of candy for you guys, but make sure you do a lot of these retracements. I can't tell you. The whole aphorism for real estate of saying location, location, location being the 3 most important things, it really does apply to us too. We can really set ourselves up for success if we get really comfortable doing retracements and looking for trades within reload zones, looking for setups within reload zones. That's going to be very powerful for us. Okay. All right. Brian, I see you chatting there. Do you have any parting words for folks for this session? All right, cool. All right, guys, have a great rest of your day. Thank you very much. Yeah, bye for now.